Well, thank you very much, Fred. It's a pleasure once again to return to this podium. I will not, of course, review my last forecast, which seems to have been overtaken by events. The events of last fall, indeed, removed all doubt as to whether the U.S. economy and the world economy would have a recession in 2008, 2009. The U.S. economy suffered a 6.3% annual rate of decline of GDP in the fourth quarter, the steepest quarterly decline since the early 1980s. And the world economy, at least as the IMF measures it, also is estimated to have seen a shrinkage of world GDP at about a 6% annual rate in the fourth quarter. For the world economy, there probably is no other quarter in post-war history where we had such a concentrated decline in output, and especially in industrial production and in the volume of world trade. The first quarter of this year is also seeing a continuing decline in output across most of the world economy. And it appears likely that output will continue to contract at least through the second quarter of this year, and many think for a number of quarters after that. So it looks now pretty certain that on a year-over-year basis, global real GDP will have an outright decline, I think probably between 0.5% and 1%. And the U.S. economy and the advanced economies generally will suffer substantially larger output declines. Meanwhile, inflation, which a year ago was probably the leading world economic issue, with the global CPI rate having risen to 6% on a 12-month basis versus not much above 2% in 2003. Global inflation has abated dramatically. 3-month figures have it negative. The 12-month figures have come down to around 4% or so and are clearly headed lower. So inflation is really not on the near-term horizon, at least, as a key policy concern. Well, in these remarks, I want to, one, talk a little bit about what has caused this sudden deterioration in economic conditions worldwide. Second, talk about global prospects in countries other than the United States, and then focus primary attention on the U.S. economy, its recession, and the prospects for a recovery. First, on the causes, what causes recessions? Negative shocks. Economy likes to move forward at some reasonable pace as productive capacity expands, and then whammo, something comes along that knocks it off track. What causes recoveries? The shocks dissipate and the natural process of economic recovery takes over, often aided by policy stimulus, at least in the post-war period. What were the shocks? Well, we had a very large shock through the financial system, hitting the global economy in the autumn of last year, which was set off, at least in terms of timing, around the middle of September with the outright failure of Lehman Brothers, the intervention in AIG, but also significant problems with banks in Europe and elsewhere, and a kind of seizing up of global credit markets where, for the first time since the 30s, we saw key credit markets nationally and internationally simply stop functioning. And even extremely credit-worthy firms found they could not issue commercial paper and secure funding through that normally reliable short-term mechanism. And major banks were not prepared to lend to each other. The LIBOR interest rate spread over treasuries went up at one point to 400 basis points, but it didn't make any difference because nobody was borrowing and lending at those interest rates. Anyway, that type of credit market disturbance is, as I once described it, like ventricular fibrillation. The heart stops pumping blood around the credit system, stops circulating credit, and the effects on economic activity and trade are very negative very fast. That, however, was not the only shock. Earlier in the year, we saw commodity prices escalate, with oil prices reaching $147 a barrel in the summer. That type of commodity price surge has a big negative economic impact on importing and using countries with a little bit of a lag. Hit us right about the fourth quarter. In addition, earlier in the year and in 2007, many countries, leaving aside the United States, had been tightening their economic policies and their monetary policies because of the concern about rising inflation. That, too, operates with a lag and began to hit us just exactly when we didn't need it, around the end of last year. So a combination of shocks built upon each other and mutually reinforced across the highly interactive and integrated global economy, and we saw this rapid drop in GDP and an even much larger drop in industrial production and the volume of trade. And that is clearly continuing into the first quarter of this year, which I think is not surprising. There was very substantial negative momentum coming out of those shocks. So the question is, when is that going to end, and when might we begin to see a turnaround? It was 27 years ago that I first started my career as an economic forecaster at the Graduate School of Business Economic Forecasting panel. And at that time, I asked my then colleague, Victor Zarnowitz, who sadly died last month and who was a great expert on business cycles and business cycle forecasts, what his advice was. And he said, well, economists have never been able to forecast when expansions will end and recessions will start, or how long recessions will go and when they will stop and expansions will occur. And it's not true that long expansions are followed by deep recessions. Indeed, there is only one reliable regularity in business cycle history in the United States and elsewhere. Deep recessions are followed by steep recoveries. And economic forecasts almost never take account of this regularity. The thinking is always that this thing is going to go on forever, and when we start to turn around, it's going to be sluggish. That is the story of the L-shaped recession and recovery. And let me note now that in the business cycle history of the United States, going back as far as we can, at least with industrial production data, to the 1920s, there is only one L-shaped cyclical event. That was a very special event, the Joyous Recession, or non-recession. Between 1945 and 46, real GDP dropped 13% as federal expenditure on the war effort declined from over 40% of GDP to about 9% in terms of total federal spending, and even an enormous resurgence of private consumption and investment couldn't quite offset the impact of the decline in the war effort. Indeed, everybody was happy to relax a bit after they had worked so hard to win the war, and the recovery of GDP was essentially nil over the next 2 years. That was truly L-shaped, and it was the only occasion in which we had an L-shaped event. The 2001 recession and recovery, the recession was very shallow, and the recovery was very shallow as well, but it was still a V, just a very shallow V. Everything else, as we'll see, much more V-shaped. Well, before turning to that for the United States, let me say a few words about the prospects for the world economy. Yeah. All right. There we are. Okay. So what I foresee for the world is that GDP is going to decline this year, but that we'll have a V-shaped recovery, and it will pick up again next year. The industrial countries or the advanced economies are going to drop about 3% and then see a 3% recovery. I'll return to the United States. Japan has taken a very big hit through primarily its exports, but the domestic economy will be affected as well. They're providing substantial stimulus, and I think that they will have a turnaround that will begin before the end of this year. The UK is having its first recession in 17 years, and it will continue for a while. Their economy has a very important financial sector, which has been hard hit, and it's going to take a while for that to come around. Manufacturing will improve ultimately with a much depreciated pound, but that will take a while. In the euro area, we're also seeing a significant recession. But it's important to keep in mind that the margin of slack that has so far developed in Europe is much less than in the United States. The unemployment rate in Europe is up less than a percentage point from its trough last year, which was itself half a percentage point below the earlier low in unemployment at the beginning of the decade. And even with the output decline this year, the margin of slack in Western Europe will be substantially less than in the United States as we begin to recover from the recession. And I think that that largely accounts for the fact that the policy response has been substantially less vigorous in Europe and came later than in the United States. But I do anticipate that in Europe we will see a recovery beginning probably late this year, as well as in the United States. Turning to emerging markets, China had a sharp slowdown in growth at the end of last year. GDP growth on a quarterly basis was probably very close to zero. And that reflected both the tightening of policy and the wind down from the Beijing Olympics. The Chinese government has turned around and is engaging in massive policy stimulus through the budget, but also particularly through the monetary and credit system. And I expect that we'll see a rapid rebound in growth up to the 8% level or a little higher. But the events of late last year will still drag down GDP growth on a year-over-year basis below 8%. The story is similar for India. They are less tied into the global economy and have not suffered as much from the negative shocks. Also, they've had a fairly good monsoon, and the agricultural sector is important. So growth will be reasonably well sustained in India, but well down from the 8% or higher rates we've seen in recent years. The rest of Asia is more dependent on trade and is harder hit. The advanced Asian economies are already up with the advanced economies, and they are suffering very substantial drops in GDP this year. In Latin America, Brazil had a quite negative fourth quarter. It now looks like they'll be negative year after year. Mexico, of course, has been pulled down by events in the United States and will be influenced by the continuing U.S. Recession. And the rest of Latin America as well, to varying degrees, is being hit. So we'll have a negative year this year in Latin America, but again, I think a recovery is expected next year. Central and Eastern Europe, a number of economies are in deep trouble. Some are likely to be more around the zero line, but we'll see an output decline in the 2.5% to 3% range in Central and Eastern Europe. Russia is suffering an output decline linked both to the drop in world oil prices and to the underlying problems in the economy that high oil prices help to conceal. And there's uncertainty about what the recovery will look like both in Russia and in the rest of the CIS. The Middle East, the drop in oil prices does not directly affect real GDP, but the reduction in oil production volumes does. And there are a number of the Middle Eastern states that are dependent on the spending of oil revenues, like Dubai is sort of the outstanding example, and they're going to slow down or have outright recessions. So a substantial slowing of growth in that area. And finally, in Africa, the fund remains a little more optimistic than I am, but I think probably if they manage 2% real growth, they will do pretty well. So that's broadly my view for the world economy. The weakest year in terms of year-over-year growth on record this year, but reasonable prospects for recovery next year. Now, an important part of that story is what's going to happen in the U.S. economy and in China as well. I've already mentioned, I think the Chinese economy is going to be recovering, and as it recovers, it's going to help pull up the rest of Asia. But the Chinese horse is not going to be able to pull the wagon alone. The other big horse, the U.S. economy, also needs to get back moving forward. Well, we're undoubtedly having a recession in the U.S., and I thought it was interesting to look at what this recession is likely to look like in comparison with previous post-war recessions. My forecast is that GDP will fall at about 4% annual rate in the first quarter, fall 2.5% in the second quarter, bottom out around mid-year, have a modestly positive growth in the third quarter, and then the recovery will start to pick up in the fourth quarter and through 2010 and beyond. That forecast says that the year-over-year, the decline, in GDP for the period from the second quarter of last year through the second quarter of this year, the period in which GDP is falling, will work out at about 3.25%, which will be close to the largest declines we've seen in previous recessions. Other measures of the depth of the recession make this recession the deepest in the post-war era. In particular, if we look at how much the unemployment rate is rising, I think we'll get up to 9.5% anyway, so we'll have a 5% rise in the unemployment rate, which is the biggest of any post-war recession. In other respects, the recession is similar in some ways and different in others from earlier post-war recessions. Many recessions are dominated by the swing in inventory investment, and in 4 cases, the downswing in inventory investment is more than the total decline in GDP. That is not happening on this occasion. We're getting a quite modest decline in GDP, in inventories, but we'll see, I think, more of a decline this quarter and next. The other thing that tends to move big down in a recession is investment. Housing investment here shows a significant decline. It would be a much larger decline except for the fact that housing began to crash at the end of 2005. So the cumulative decline from the peak in housing to the trough is nearly 50%, and only a fraction of that is actually occurring over this 1-year period. The other components of business fixed investment are declining in the recession, and the decline in structures is expected to continue till well after the recession is over. Finally, consumption spending is falling in this recession. It doesn't do so in every recession. This is going to be the largest decline in consumption spending of any post-war recession. And consumption spending growth is going to be kind of sluggish coming out of the recession. So that's what the recession is going to look like. What about the recovery? Oops. Well, it's hard to say exactly when the recovery starts. I have an early starting point for it, and it could go on, and the recession could go on another quarter or so. But I think it's interesting to look at what typically happens in a recovery once it starts. And so these are the 9 previous post-war recoveries. And they're listed in the first column. Second column indicates the depth of the preceding recession in terms of the drop in real GDP. We had 2 recessions in the early 80s, in 1980, and then 2 quarters of growth, and another recession in 81, 82. And so the Reagan recovery is really from the 2 recessions combined. The strength of the recovery is measured in terms of the cumulative gain in real GDP during the first 6 quarters of the recovery, because I'm concerned in my forecast with how much the economy is likely to grow between the middle of this year and the end of 2010. And you can see that those numbers are pretty impressive. The weakest one, of course, is W's recovery, where we had a very shallow recession and a very shallow recovery. The other relatively weak recovery is the first Bush, and there we also had a 2-quarter recession that was actually probably the second mildest of the post-war period. All the others have cumulative output gains in excess of 7%. The average for all 9 is 7.7% in the first 6 quarters, and the average, excluding both the late 40s, which is an odd inventory cycle, and the W recovery, is 8.8%. So recoveries do indeed tend to be quite powerful, at least in history. So I constructed a scenario that sort of respects that general regularity, and that's listed in the 3rd column in this paper, where the second column lists the level of real GDP and its components anticipated at the cyclical trough and at the end of the 2nd quarter. And then the forecast is the gain in real GDP and its components over the next 6 quarters, and in percentage terms in the next column. And then the final 2 columns are what the scenario would look like if we had an average recovery. So notably, in a 6.2% recovery, my assumption is that consumption spending is indeed going to recover, but at a significantly lower rate than GDP. The savings rate is going to go up, and it's going to reach about 7% in my forecast by the end of 2010. Obviously, durables, which get hard hit in the recession, have a big gain, and services keep growing. Gross private domestic investment, as it does in every recovery, has a large gain, 25%. Structures, I assume, will continue to shrink a little bit. That may or may not be right, depending upon how much the fiscal stimulus actually boosts private investment in structures. Equipment and software always has a big cyclical recovery, 6 quarters out. And residential investment has a large gain, but the level of residential investment is still 30% below the peak reached at the end of 2007. So this is a modest recovery. New home building is going up in this forecast to a little over 1 million units per year from about 500,000 at the bottom. And finally, inventory investment makes a significant contribution, but far less than in most cyclical recoveries. Net exports, I assume, will deteriorate in this expansion. The U.S. economy will recover earlier and more strongly than most of its trading partners, and we will be exporting demand to the rest of the world, and that will be a drag on our own recovery. Now, some might say that this is an optimistic forecast. I regard it as conservative, and indeed it is below the average of post-war recoveries. And we are recovering from a particularly deep recession where, in the past, recoveries have tended to be really quite strong. So substantial allowance is made here, both for the considerable possibility that the recovery might not get started quite as early as I have indicated, but also for the factors that are likely to restrain a bit the pace of this recovery in comparison with earlier ones. The alternative scenario of the average shows that one can easily have a substantially stronger cyclical economy without being by any means outside the range of what might be regarded as reasonable. Now, finally, let me say a word about policy, in particular monetary policy. The Federal Reserve has an enormously expansive monetary policy. And that's expansive on both sides of the balance sheet. They're buying up assets, lending out money on the asset side in order to restart various financial markets and provide credit directly to support those markets. The liability side has to be expanding as well. And they are just stuffing excess reserves onto the banks. They're holding over $800 billion of excess reserves now. The Fed's balance sheet goes up on the asset side to $3 trillion, which I think it will and may go higher. The level of excess reserves is going to reach $1.5 trillion or $2 trillion. Now, banks may pay down some of their borrowing, but they're going to have a huge volume of excess reserves on which they're earning 1/4 percentage point. And I believe at some point they're going to say, gee, we could earn another 100, 150, 200, 300 basis points if we actually lent this money to somebody else. So I think there's going to be plenty of credit available for the banking system to lend out and plenty of incentive for them to do so. And in the end, this will work to promote recovery in the private sector. Now, many say that, well, we need to fix the banks first. I have no particular problem with fixing the banks, but I note that that's not the way in which it's usually happened in the past. In the deep recession of the mid-'70s and particularly the early '80s, the banks were in terrible shape. We didn't admit it because we didn't mark to market the value of their assets, but they were deeply insolvent in the early 1980s. And the savings and loan industry never really recovered. They were insolvent throughout the entire expansion. Nevertheless, the expansion came, and the housing sector recovered, even though its principal lender, the savings and loan industry, was deeply insolvent. So what has happened typically in the past is the recovery of the economy has helped fix the banks, and it has not been necessary to solve all or most of the problems with bank balance sheets before one stimulates the recovery. And that's been true not only in the United States. If we look at the many countries that had financial crises in the time I was at the fund, boy, the banks remained in rotten shape as the economies recovered spectacularly, at least from the initial stages of the recession. So I think that Victor Zarnowitz will be proved right again, and that we will see a V-shaped recovery. Whether it will start quite as soon as I have in mind or not is, I think, a reasonable issue to question. But when it starts, I think that it is far more likely than not that the U.S. economy and the world economy will see the V for Victor.
Thanks very much for this opportunity. And I guess despite what Fred said, I think there is a very stark contrast between the views of the future, the immediate future that Mike just presented very clearly and articulately, and the view that I'll put forward as my baseline view at least. And I think, while I'm not insisting that this be an L, literally speaking a flat L, sometimes my daughters draw L's that kind of have squiggly lines or point up a little bit. I think the basic point that I would suggest is that it is a sluggish recovery. It's a recovery that really struggles to take hold, both in the United States and globally. And it's not a V in the foreseeable future in 2010, and perhaps even in 2011, of the kind that Mike laid out. Now, and I think Mike sort of emphasized the key point here, which is if I'm to be right, then this has to be different from pretty much anything we've seen before in the data. And I'm always suspicious, and I'm sure all of you are always suspicious, and you should always be suspicious of anyone who stands up before you and says, the world has changed completely, disregard all previous relevant, or all previous observations you thought were relevant, and let's think about this differently. I think that's generally not true, and people say that far too often. And I guess I take a little bit of comfort from the fact that I said that at the end of September last year, and with some reluctance, and was met by fairly universal disbelief. And I guess the forecast we made for 2009 during the fall was that there would be a contraction of about 1% in global GDP, which at the time seemed kind of outrageous and was really a statement that the world had changed. And I think that turns out to have been more or less in the right ballpark. Doesn't mean we'll be right on the recovery, but we did have a good sense of the downturn. And when I say we, I'm speaking of a small group with whom I cooperate in running a website called Baseline Scenario, Peter Boone and James Kwok in particular. And our views are there, and our views can always be found on the Peterson Institute website as well, although Steve often changed the titles of my blog posts to make them more appealing or more understandable or something. So you can track us through the Peterson Institute website. It's a very good way to do that. And we do blog. It's a very inelegant word. It doesn't sound like a very serious word, perhaps, but I think it's a descriptive word. We do post on the website every day, and we do try to update our baseline view. I'd like to recognize my former colleague, Charles Collins. The fact that all the IMF people are sitting at Mike Mussa's table, I'm sure, and not at my table, is pure coincidence, and nothing at all to do with their priors on this matter. But Charles and I used to talk a lot about the forecast. Charles runs the World Economic Outlook and was in charge of it when I was at the IMF. And I was always very keen to move the baseline. And Charles would always explain to me the problems, both organizationally, politically, and substantively, with moving the baseline forecast. So now I have my own baseline, Charles, and I move it on a daily basis. That's right. Charles gets less sleep and moves the baseline more often now. So how can the world have changed? What happened in the fall? What's happening now? What happened before that? What's the basis of the argument? And I would refer you. I'm going to refer you to a number of pieces that we've done available through Peterson and through our website that try and articulate this in more detail. And I think that the basic point, which you can either accept or reject or study a little bit further, is that the U.S., the heart of the global economy, the U.S., and I would include Europe also. I won't spend a lot of time speaking about Europe in these remarks, but we can talk about it in the question and answer. I think the industrialized countries, particularly the US, have become a lot more like emerging markets than we've ever seen before. Now, we had this idea, I think, previously that development and modern economic growth was about emerging markets trying to become more like industrialized countries, succeeding or failing, hitting various bumps in the road, being subject to capital flow shocks and so on. I don't question that it can be a useful way to think about it, but I think what we're looking at right now is a U.S. that's become much more fundamentally unstable because of the way the financial sector developed. And this is an article, I refer you here to an article that I just published in The Atlantic magazine. It's also available online. In which we argue this through, and we argue that the financial sector boom that happened in the United States and in other countries had a characteristic very much like an emerging market boom, where at first it makes sense. At first you have some efficiency gains, you're generating sensible profits, and then it gets a little bit, the sector gets more politically powerful. It's able to take control of its own regulatory destiny, let's say, and particularly as technological innovation occurs and derivatives arrive, but it's not only about derivatives, that the sector has an opportunity to construct its own future profit opportunities, and it does that in a way that feeds into further concentration of political power. And I think, to be honest, we have allowed to develop in this country a sector that is dangerous. And has caused this extraordinary degree of collapse, unprecedented degree of collapse, speed of collapse in the U.S. and in the global economy, unprecedented since in the post-war period certainly. And I think it's a problem for the recovery. I think this is not just about. This is not just about the banks, and it's not just about the recovery in particular. It's not just about the banks, but I think the banks are the heart of the matter, and it's the political power of the banks that presents the most substantial problem to this administration in terms of moving forward with sensible policies. Or actually, I go further, I would say that most of the administration's policies I support, and some of them I support very strongly, including on our website on a daily basis. But the financial rescue part of their policies, I think, makes less sense. I think it caters too much to the financial sector in ways that are not good for the growth of the economy or for society as a whole. And we take issue with that, and I'm happy to discuss that further. But if this is right, if the instability, if the collapse, if the decline we've seen so far is something about the US, the core of the system, having become more like what we used to call the periphery, and now it's all mushed together, what are the implications for the recovery? Well, partly you can worry about the banking system, and I do worry about the banking system. If you look at credit default swap spreads on major so-called non-bank holding companies, the holding companies that own banks that aren't banks and aren't subject currently to, as the administration presents it, a resolution authority, and that's why they're seeking a new resolution authority that will allow them to deal with these entities. If you look at what's happened to these swap spreads, the implied probability of default in the market, they've actually increased over the past couple of weeks, while other credit risks have according to the market, got better. European sovereign spreads, for example, are down. While, of course, the equity market has enjoyed a pretty strong rally. Something is still going wrong with the banks, and the chance that we get out of this without further collapse, either a sudden collapse or a more gradual collapse, I think is rather limited. So that there are problems within the short term of the financial system. There are also problems in terms of the growth potential of the financial sector. These economies, I think pretty much all the economies represented here today, moved much more of the GDP into finance since 1980. And I would question the degree to which that's sustainable. So if, in addition to the financial disruption, there's also a change in the allocation of talent and the allocation of capital within these economies, that's a long, drawn-out process that's not made any easier by the fact that credit private credit is largely or at least partly still stuck and jammed up. In addition, of course, we have issues that go far beyond the banking system with regards to balance sheets. The balance sheets of consumers and the balance sheets of businesses are, I think, damaged and viewed as being damaged. And I think that this is the sense in which the Japan scenario of the 1990s strikes me and others as being relevant, that if consumers are trying to pay down their debt globally, and if businesses are trying to be more careful, one of my close colleagues at MIT is from Finland and tells me stories about how after the Finnish severe recession in the early 1990s, his company and other companies really regarded taking credit as extremely risky because you didn't know if the credit would be there in the future. And they would take every single cent they had, they would use to try and pay down their debt, and on a precautionary basis. Okay? So I think that this is, to my way of thinking, a global collapse and a difficult recovery based on the problems of the financial system, based on the fact the financial system becomes so powerful and is so difficult that's such a difficult problem to address, perhaps particularly in the United States, but in all industrialized countries. And also that it's spread to confidence, it's spread to the debt levels that people want to have. Of course, Fred's right. We have no idea where this goes. I mean, that's my point, is that we are really in uncharted territory. President Obama said it's the greatest financial crisis since the Great Depression, and I think that's absolutely right. And we have what is the degree of leverage? How much leverage are people willing to have in the corporate sector or in the household sector going forward? I have no idea. I think that they will not want to have the degree of indebtedness that they had to this date, and I think that this will fit very much into a Japan-type sluggish recovery at a global level. And remember, most of the bounce backs, of course, Mike's right. The most rapid collapses that we've seen. Well, if I take Mike's statement and apply that to emerging markets, most rapid collapses in emerging markets many of them are followed by rapid recoveries. But that typically involves a big real exchange rate depreciation and a rapid increase in exports. Right? Japan's 1990s, if you remember, didn't have that feature, but they did have a strong export performance throughout the decade. At the global level, what's the equivalent of a big real depreciation and a lot of exports? I'm not sure if Mars is open for business on that level, and I think that it's going to be difficult. right? So it's the negative parts of an emerging market collapse without the positive, without the ability to grow. Or my Scandinavian colleagues tell me that they also benefited from a strong, robust world economy as the Scandinavian recoveries began in the mid-1990s. Let me conclude with a couple of remarks about policy, and perhaps bring up the G20, and also make it clear that I'm as critical of European government policy as US policy, just to be fair and even-handed, which is an important thing for the IMF table. I think that the G20 summit, to my way of thinking, didn't deal with any of the first-order questions. I think there was no additional fiscal stimulus coming out of the summit or the process. I think there is this unfortunate and, to my mind, anachronistic reluctance on the parts of heads of government to discuss monetary policy, which I'll come back to in a moment. I think that is a huge part of the ballgame right now, and on this I think I would agree with Mike. I also think the regulatory discussion is not really going anywhere in a productive way, and this is all elaborated on my website. And you can, by the way, the comments are completely unmoderated there, so you can say all kinds of things about me, anonymously even. So it's very satisfying. And I think there was no serious discussion around the G20 about how you deal with the banking problems, about this issue of what you're doing to recapitalize banks. I think that there is no strategy for that yet in the United States, and I question whether the Europeans can actually afford their strategy. And I think that a big part of the problem in terms of policy response is in Europe, and particularly in Western Europe. And I've been urging for some time, at least since October, for West European governments to take seriously the fact that Eastern Europe is suffering, will continue to suffer a massive slowdown, that property markets in some West European countries, most obviously the UK, Ireland and Spain, are really deteriorating fast, and that has implications for banking. And of course, exports are coming down in many European countries also, which has further implications for banking. Now, I do think that the G20 summit, and I do regard it as a success in these terms, partly because my expectations were sufficiently low. I think that the additional support that was given to the IMF, the money that was given to the IMF, both in terms of the additional credits promised and the prospect of a new arrangements to borrow arrangement, $500 billion, reportedly. This is good. I think the special drawing rights allocation has the potential to be excellent. I think, in particular, the idea that I understand the Americans and perhaps some others insisted on, which is this provides ready resources or reserves that some European governments, presumably surplus European countries, can lend to European countries with deficits. I think that's an excellent idea. And I think that you should regard it as a pilot project. I understand that there are fears of that creating an immediate global inflation, and there are fears about this somehow being misused. And obviously the modes of operation around that have to be worked out. But I think if it makes progress, and if the recovery really fails to take hold by September, the next G20 summit, I think there'll be a discussion of a much larger SDR allocation, which I fully understand would require congressional authorization, as well as many other discussions. But I think that this SDR move, which of course I don't know if Ted Truman is here, but I don't. Okay, Ted Truman is blushing. I think he should be. I think that this is a terrific idea that Ted has been promoting for a long time, and many of us, including myself, I would say, didn't think it would ever take hold or win political support. And I don't know how he and others did it, and perhaps you shouldn't tell me. But it's. I think that there really is a very positive step, and I think it really indicates, it creates a potential, I think, for dramatic further action, should that be needed, at fairly short notice. And I think the G20 should be absolutely applauded for that, and I have applauded them repeatedly. On the final note, monetary policy. And this is something which I published an article in the Washington Post Outlook section on Sunday, saying that I actually, and I'm trying to be very careful and very clear about which parts of the US government policy I support, to what extent, and which parts I oppose. As I said, I'm very skeptical of everything that's happening on the financial reform, that would be in inverted commas, reform side. Financial rescue, I think, is not at all going well. I'm happy to elaborate on that, or you can just read my website. But I think in terms of monetary policy, I would put it like this, and this is what we said in the Washington Post article. I think that the steps being taken by Mr. Bernanke and his colleagues, and the risks that they're taking, are extraordinary and unprecedented but I support them fully. I do agree with Mr. Trichet, the head of the European Central Bank, that there are risks of inflation in this situation. I am not of the view, and we explained it there, and we explained it also in further, slightly more technical detail on Monday on our website. I do not agree that there's no risk of inflation in this situation. I think, again, because the dynamics of this economy have changed, because we've become more like an emerging market, standard, conventional US-type macro models of inflation based around some notion of an output gap don't necessarily apply. I don't know that they don't apply. But my prior is quite weighted towards this having other features of an emerging market, and one of those would be that the kind of monetary policy being undertaken, the kind of credit support that Mike nicely summarized, could well lead to inflation, even while unemployment, for example, is still rising, which would be, I agree, extraordinary, unprecedented, and you'd put that in the ever-growing list of extraordinary and unprecedented developments in this country over the past 6 months. So I think there is a risk of inflation. I think there's very little. I think the Fed doesn't have much option. I mean, I think that the risks that Mr. Bernanke is taking in terms of economic outcomes and in terms of the future independence of the Fed are very real. I think it shows great courage. I respect fully the view of the European Central Bank that inflation is a risk in this situation, and I think they're wrong in their policy. I don't think they are reading the risks right. I think the risks are on both sides quite severe, and I'm on the side of Mr. Bernanke in thinking that he's reading this one right. I would say also that just in closing, I recognise that Mike appears at every one of these sessions, and contenders come and go. So either we can talk again in September, October, or if you don't see me, you know what happened. Thank you very much.